I'm John Marino, Senior Editor of The Deal, and today we're joined by WP Carey Executive Director Katie Barthmaier. We're talking about transactions in the sale-leaseback arena. It's something on public markets that's gotten a lot of attention lately. Red Lobster being spun out of Darden brands, and they're also spinning off the real estate properties separately from the company and the transaction. This isn't something that's just unique to this one company, although they've been under targets from activist investors. I'm curious to know what you're seeing in the space lately and what's accountable for the growing trend of sale-leasebacks.
Right, thank you, John. I think the Red Lobster transaction, due to its size at $1.5 billion and 500 properties, has been very visible recently. But the concept of using a sale-leaseback transaction to finance a private equity portfolio company or to fund LBO or M&A activity is not a new phenomenon. An early example of a transaction that we worked on at WP Carey was in 1982 when we worked with Westray as they were acquiring Gibson greeting cards. We bought about 3 million square feet of real estate assets that the company owned for $34 million and helped to finance the $340 million acquisition of the company. And in today's market, particularly with the low interest rates, I think private equity firms are continuing to see sale-leaseback transactions as a very attractive source of capital. An example of a transaction that we recently worked on is with a company called Janus International. Janus is a manufacturer of rolling storage doors, mostly used in the self-storage industry. The company was acquired in December of 2013 by Sawmill Capital. And Sawmill realized that there was a lot of value tied up in these 3 manufacturing facilities that the company owned. So they came to us and asked us to enter into a sale-leaseback transaction for 20 years for the properties. And these were really core manufacturing assets, the only manufacturing facilities that the company owned. And today we're actually even expanding the Arizona facility to help fund their future growth.
All right. And it seems to me like private equity has increasingly been interested in doing deals in this space. We're also seeing at the same time a lot of real estate focused funds being raised in the hedge fund community and also by PE. I'm curious to know, I guess, a little bit more about where you see PE heading in the space. It seems like we're going to be seeing more of these transactions in the future.
Yeah, I think that sale-leaseback transactions and net lease transactions are very attractive. Again, particularly today with the low interest rate environment, it's just another source of capital that can be used in these types of transactions.
And talk for a little bit really quickly about risk. Obviously, whenever you see a lot of capital coming into a new space, you have to worry about what risk they're taking on. What maybe are some investors not taking into account when they come diving into the space? And maybe also in other sectors, not just focusing on restaurants, but what is taking place, for example, with office space? Sure.
So I think the risks today are really the same as they've always been, which means that an investor has to stay diligent and follow their processes. So we at WP Carey look at a few different items as we're analyzing each new potential transaction. One is the credit of the company. What's their industry? How strong is the company? Will they be around for the next 15, 20, 25 years to pay rent? The second factor that we look at is the real estate and the quality of the real estate. Where is it located? What type of facility is it? How old is it? So we understand what we can do with that property in a downside scenario. The third criteria that we look at is the criticality of the asset. Is this an incredibly important asset to the company's operations? So again, if they run into any problems, they'll continue to need that facility. So in the case of Janus, where we acquired all of their manufacturing facilities, the idea is that they will need those properties for the long term. And then finally, we balance those 3 criteria to determine the appropriate transaction structuring and pricing for the opportunity.
All right. Thank you very much, Katie. That's Katie Barthmaier from WP Carey joining us as part of our ongoing executive interview series at The Deal. For The Deal, I'm John Marino. Have a great day.